A year ago, I've talked about the opening channel, which includes the opening of the Frankfurt and the London sessions. The strategy was based on two fundamental factors, price and time. I found several methods to improve that strategy and made it even better for beginner traders. So if you could, like, subscribe to the channel and stick around for the full video. For this day trading strategy, it's essential to know the opening and closing times of the various trading sessions, and depending on where you are in the world, days and times may differ. The trading day consists of multiple sessions: the European session, the American session, and the Asian session, or London, New York, and the sessions in Tokyo and Sydney. We are interested in the London Open, which starts at 8 AM GMT, and the Frankfurt Open, which starts 1 hour before at 7 AM GMT. This trading hour between 7 and 8 GMT often creates the trend of the day, giving you several opportunities to take advantage of price action around it. Now, obviously, you don't want to spend time every day to draw the opening channel yourself. Let me show you how you do this in TradingView. First, you add this indicator, FX Market Sessions. You don't need the indicator to display all trading sessions, so we'll keep only the London tab, and we'll hide the rest. Now it displays only the London session, but we want the indicator to draw the channel, not the entire session. Here's how to plot the channel, depending on your time zone. I live in Romania, Bucharest, so my time zone is this one, UTC +3. In my time zone, the London session starts at 10 AM. In your time zone, it will be different. To draw the opening channel, you put the initial opening time in the second tab, so we'll choose here 8 AM. And in the first tab, it's the Frankfurt Open, 7 AM. Now let's change the color of the channel to make it obvious, so choose a darker color and rename it as the opening channel. And there you have it. These lines represent the low price and the high price formed within this hour. The high and low price of the channel are the first support and the first resistance for the trading day. The trade plan is to find imbalances in the market at the start of the European session. If the price goes above the channel, buyers are showing signs of strength. If the price goes below, sellers are trying to gain control of price. When price is inside the channel, there is no imbalance between buyers and sellers. You cannot know which direction to expect, so you don't want to trade when price is inside the channel. Think at the opening channel as the area within which you never have to enter the market for the rest of the trading day. When price breaks upwards or downwards, then you will have a long or a short signal. On its own, this day trading strategy is quite powerful, with many good signals. Here's a successful downward breakout. And here's an upward breakout, with a strong trend afterwards. But there are also days like this one, when the channel is broken to the upside, then to the downside, with no momentum after the breakout. You will encounter days like this one, and it will be frustrating. So let me present to you some filters to try to eliminate those choppy days. First filter is market fractals. Fractals indicate swing points or turning points and are one of the best signals when trading price action. Fractals are a 5 bars model in which the third or the middle bar represents the highest high or the lowest low. In an up fractal, the middle bar will have a higher high than both of the bars around it. In a down fractal, the middle bar will have a lower low than both of the bars around it. So the fractal arrow appears only above or below the third candlestick if it is the highest or the lowest of the 5 bars. A bearish fractal serves as a resistance, and a bullish fractal acts as a support. I found that fractals, in combination with the opening channel, offer quite decent signals. This is basically a 100% price action approach. A fractal arrow shows at least a temporary level of support or a temporary level of resistance. If the highest point of a fractal coincides with the opening channel, then the fractal pattern is more reliable and more likely to be an accurate indicator of a market reversal. In this case, we'll look for short signals. If the low point of a fractal coincides with the opening channel, we'll look for long signals. Basically, we want the opening channel to contain a market fractal as a confluence factor to increase the odds of a valid breakout. We'll use the 15-minute and the 5-minute timeframes to find signals. This is an example of a strong signal. We trade gold on the 15-minute timeframe. Observe the opening channel and the fractal arrow, which appeared during this hour between 7 and 8 GMT. This is an indication that the breakout is likely to be to the downside, so the correct trade would be a short one when price closes below the channel. Always wait until a candle actually closes below the channel. This is the signal candle, which confirms the breakout. Stop loss is positioned on the opposite side of the opening channel. Profit target depends a lot on the market you are trading. Aim for at least 1.5 risk to reward, ideally 2 to 1. You can even trade the other side of the channel if conditions are favorable. In this case, we have another fractal signal followed by an upward breakout later in the day. Here's a strong short signal. We have the opening channel and the fractal, signaling a potential breakout to the downside. This is the signal candle, which closed below the lower line of the channel. Stop loss goes above the channel, and the profit target was reached with ease during the day. The next day offered us another strong signal. We have the opening channel and the fractal, signaling a potential breakout to the upside. This was our signal candle, closing above the upper line of the channel. Stop loss below the channel, and again, almost a perfect trade. The money management plays an important role. There will be days with giant moves, and you know how frustrating it is to exit early, only to see the market continuing in your expected direction. You could try to implement a trailing stop, or maybe exit 50% of your position, move your stop to break even, and enjoy the risk-free trade. Another good filter for the opening channel is Heikin Ashi, because these charts have longer runs of green and red candlesticks. Heikin Ashi candles tend to stay red during a downtrend and green during an uptrend, and this will help you eliminate some false breakouts. Just be careful because each of the Heikin Ashi bars start from the middle of the bar before it and not from the level where the previous candle has closed. So make sure you check these two options in TradingView, last price line, and real price on price scale instead of Heikin Ashi price. Here you have to rely again on price action, which is slightly different from the classic one. Green candles signify an uptrend. Red candles indicate a downtrend. Green candles with no lower shadows show a strong uptrend. Red candles with no higher shadows identify a strong downtrend, and candles with a small body that have upper and lower shadows could signal a trend change. Here we have a long entry at the opening of the London session. We are trading crude oil on the 15-minute time frame. The signal is valid because we have a bullish green Heikin Ashi candle breaking the range, and the candle has no lower wick. This means momentum is bullish and price is likely to continue upwards. If you are aggressive, you can also trade on the other side of the channel. This big bold red candle broke the channel on the short side, and this was another opportunity to trade. The safest way to trade the channel is in the direction of the dominant trend. You must take into account swing highs and lows and trade continuations of trends. In this example, we have 4 consecutive trading days. During the first day, we have a minor uptrend, and the conservative way was to trade a breakout to the upside, which was successful. The second day, we have this break of structure right here. In fact, the opening channel represented the break of structure, a warning sign that the previous uptrend is getting weaker. So the long signal here at the break of the upper side of the channel could have been avoided, and the short later in the day would have been the correct trade. During the third day, the trend was down, so this breakout to the downside was a valid opportunity. The next day, again, seemed like another bearish day, with the opening channel making new lows in the downtrend. So another short below the channel and another decent trade. Of course, it's not as easy in real time. You need to have a set of price action skills, which you must apply to any market to make sense of it. When trading the channel, the worst scenario is for price to break it on one side and then return inside the channel, maybe breaking the other side and returning inside once again. You can profit from the channel when the markets are moving and not when they are ranging. One way to identify whether the market has potential to move or ranging is by using the choppiness index. This indicator basically helps to identify whether the market is choppy, meaning consolidating or trading sideways. The value of choppiness index indicator ranges between 0 and 100. A high reading in the choppiness index usually happens when there is a significant consolidation in the price action. When the value of the indicator is above 61.8, it means that the market is moving sideways in a choppy manner. Usually, the trend continues to be sideways as long as the choppiness index stays above the 50 line. In this example, we have the channel here and the breakout. Now look at the choppiness index reaching high values, and also look at the price action in general. Despite the channel breakout, you see nothing but consolidation, sideways moves, and market indecision. So the closer the value is to 100, the higher the choppiness levels. When the value of the indicator is below 38.2, it means that the market is trending. Usually, the market has potential to trend as long as the choppiness index stays below the mid-50 line. In this example, observe the channel and the breakout. When the indicator shows lower values, the breakout has the potential to be successful. So the closer the value is to 0, the stronger the market is trending. But very important, don't rely too much on this indicator. Use it only when you are in doubt and when other market conditions are not clear. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. and check out our Academy program if you want to further level up your trading. Until next time.